and research here at FIG. Joining me today to conduct the presentation is Jake Conduction. Jake has over 20 years markets experience and including trading and portfolio management, and he's traded bonds, shares and options, and has had many years experience, but at the moment now he's just concentrating on fixed income here at FIG. Jake has a lovely smooth Canadian accent, so I'm hoping you'll enjoy listening to him today. A couple of little housekeeping notices, if you like, before we get underway. On the right hand side of your screen you should see a table, if you like. If you can't see a table, there's a little orange arrow, and if you click on that, that will expand. About 3/4 of the way down that table is a section called questions. So if you'd like to ask some questions today, Jake and I'd be very happy to answer them. If we don't get time to answer your questions, we'll certainly email you or call you at the end of the session, but we will try and answer as many questions as possible. So without further ado, we'll start today's webinar, and I'll hand over to you, Jake. Thanks.
Thanks, Liz. I'll do my best on the smooth part. It's definitely a Canadian accent, but appreciate the intro. It's kind of you. So as you see on your screen, currently we've got a disclaimer. Please take the time to read it, but I'll give you a quick summary. We're general advisors here at FIG. We don't take any consideration for your personal circumstances. We certainly know our marketplace inside out, and but whether these bonds or fixed income instruments are right for you, we don't know. So we're general advisors, not personal advisors. We don't take your personal circumstances into consideration, but we can certainly tell you everything there is to know about the fixed income area because we're the fixed income experts. So a little bit about who FIG is. That's what this, we were set up about 15, 16 years ago by Jim Stenning, who opened up the doors with the vision of opening up the bond market. We're now the experts in the fixed income field. That's all we deal in. That's the beginning and the end. Where we have research, dedicated research, expert research in fixed income area, and we're not aligned with anybody else. We're here just to do the best job for you, the investor base. We're growing quite rapidly. We have over 5,000 clients, probably a lot more than that now. This slide was prepared a little while back, but clients like trusts, charities, councils, a large number of self-managed super funds, individual accounts and joint accounts. So quite a large number of clients are joining on and learning about bonds and capturing the value there. Over 11 billion of funds under investment now, and over 15 years experience. And what you see at the picture you see there is our online site right now. One thing I want to point out is that a lot of our information is available online. The research is available to find online, as well as monthly statements for existing clients. Daily pricing is updated for anybody who has an existing account open. So, and we've received a lot of positive feedback for our online initiatives. So if you do open up an account, there's a lot more available to see. But let's drive on here. So what you see in front of you is a typical risk-reward trade-off. So on the horizontal axis, you see risk. So if you take more risk, you expect higher return. On the vertical axis is the return. And so if you shift out to the high risk areas, those are your stocks and property, and for taking these high risks you expect higher returns. And conversely, on the other side of the lower risk area, you would expect lower returns. Your term deposits and bonds, these are what I call sleep at night assets. They're the ones that keep you calm and relaxed and offer good high safety, but of course offer lower return for that. And in the middle are the hybrids, and a hybrid is a mix of I guess it's got stock-like features as well as some fixed income type features. Hybrids are designed to provide a cash flow for you, but they also have share-like characteristics that certainly in the negative times can certainly come out, and we'll look at some graphs later on. So in the property space, certainly, especially in this country, we've enjoyed a large property gain over the last 20, 30 years. I'd say the major downside for property is the illiquidity and the maintenance costs, and I guess the stamp duties and the tenants can be difficult. So for those higher returns that you expect, you have to give up something, and typically liquidity is one of them, and there are some other hassles, of course. And in the share side, liquidity is quite good normally, especially in the good times. So liquidity is very, very good in the share side. Having traded for almost 20 years now, it's certainly been across all these asset categories in my career. But shares typically quite good. But for that, from a liquidity standpoint, but for those higher returns that you expect, you have to accept some volatility. I can certainly think quite a few scenarios over my career, as well as not even that long ago. Reject Shop QBE comes to mind, where we had some major moves downwards in price just because you missed the analyst expectation by a half penny. So volatility tends to be the downside, but for the share area, but for that volatility you expect higher returns. Now moving to the higher safety area, the TDs, certainly you do get sleep at night. You don't sit up at night worrying about your TD returns. For that ultra safety, you have to give up return, and I guess with inflation tracking at 3% currently, you got that return, the real return after inflation is getting quite meager these days, and of course liquidity is low in the TD space. You can sometimes break these things, but liquidity is not great in the TD space. What we're going to talk about a lot today is the bond space. There's an area where you can play it safe, and you are getting returns anywhere from 5.5 to 7. I've seen some higher returns, but typically 5.5 to 7 is the normal range now. You can buy and sell many bonds in $10,000 increments, and it offers diversification away from the share side. So here's an asset class. So again, you're playing it safe. You're getting a nice solid return, usually about 2.5 to 3% above the TD space. So right now it's about 5.5 to 7% kind of range. You've got liquidity. You can buy and sell in $10,000 parcels for many of these bonds. And it adds some diversification benefits away from the share area. So here's an asset class that we're going to concentrate on a little bit more today, and not a lot of folks know a lot about. So let's keep digging into it. So just take a moment to take a look at all those logos you see on your screen. Hopefully the IT side's working today. And you see on your screen NAB, BHP, Origin, Telstra, Commonwealth Bank, Rabobank, AXA. These are all companies we know and have used for decades and have survived for decades and likely to survive for many more years to come. They also happen to be bond issuers, the companies that have issued bonds for decades and will continue to offer bonds into the marketplace. So a bond, a corporate bond, is simply a loan to a company. It's an IOU to one of these companies. So you're lending money. And overall, the bond market's at least twice as big as the share market. It really is a giant asset class that unfortunately folks here in Australia don't really know too well, but a real huge marketplace. Your typical portfolio overseas, especially the pensions, are I'd say closer to 50% allocated towards the bond space, but on average you're over 20% allocated to bonds. And then here in Australia, the average SMSF has less than 1% in bonds. So again, kind of an odd duck when you look around the traps. Certainly the rest of the world enjoys bonds and the benefits and the diversification benefits, the excess returns you can capture with this high safety oriented asset. But here in Australia, very underutilized. Now, I guess one of the reasons why it was quite underutilized here in Australia is the minimum was $500,000 per bond, and that's why FIG opened its doors 15, 16 years ago with the vision of offering these high-quality assets with good liquidity, good returns, diversification benefits to everyday people. It's kind of a weird scenario moving from overseas to here and recognizing that the marketplace here is well, I guess it was only for the big boys. You had to be a certain size before you could buy one bond. So FIG broke up that club, broke up the big boys club and said, you know what, $500,000 per bond is way too much. And here we are 15 years later after opening the doors, and you can now buy bonds down to $10,000 parcels. Now, some of this change has come from a couple different areas. Investors like you folks on the line right now, you're taking the reins yourselves. You're learning about what bonds are, why they're safe, and how they can be beneficial for your overall portfolio. So investors such as yourselves are changing the marketplace. You're demanding higher returns than the term deposit space. You want to diversify away from the share market and the property market. You're asking for the liquidity, you're asking for the extra returns, and you're taking the reins and learning about why bonds are safe. So you're driving this change. So FIG is helping to make it happen as well. On the other side, the supply side of bonds, that's also changing. A lot of companies here in Australia, they feel hamstrung by the banks. They want to diversify their sources of borrowing because guess what? If ANZ says no to you, then probably the other major banks will probably also say no to you. So diversifying their sources of funding is quite it makes a company overall safer if they can borrow from not only from the banks but from the bond market, from the share market, from overseas. This helps companies diversify their funding and makes them safer. They also want to extend out their loans. They don't want to be stuck to a 1 year or 2 year time frame, which a lot of banks do strap them to. So companies are coming to the bond market to I guess extend the length of their loans and diversify their source of borrowing. So on the supply side, companies are coming to the table and offering more bonds, and on the demand side, investors like yourselves on this line are learning about what assets are, what bonds are, and taking the reins and learning about it so that you can add value to your own portfolio, make your cash work harder. So let's keep digging here, and I don't want to keep yammering on. I want to get to the big guns, Liz Moran. She is an expert. She's the leading expert on the corporate bond space. She's a columnist for the Smart Income column in the Australian. I know I read that every weekend. She also contributes to the Eureka Report, AFR, the ASX, quite a few other media outlets. She's, I'm proud to say, the Director of Education and Research. I've had the privilege of working with her for 3 years now. Miss Elizabeth Moran.
Thanks, Jake. Not sure I wholly deserve that introduction. Very kind introduction. Okay, let's get down to business. So what is a bond? As Jake said, a bond is just a loan from an investor like yourselves to the company. So because it's a loan, it's a legal obligation and the company must pay you your interest and principal when they say they're going to. It's a really important distinction compared to shares, because shareholders, of course, are owners of the company, and as owners of the company, they take a share in the profits. But there is no obligation, legal obligation for the company to pay a dividend. In fact, we've seen many companies cut dividends or not pay at all. Of course, there's no guaranteed repayment of capital at the end, and you don't actually know what your return is as a shareholder until you sell your shares, and then you know what your return has been. So with bonds, it's quite different. It's quite a different analysis, if you like, prior to investing. What you're looking for as a bond investor is, the question you would ask yourself is, can the company survive? Because if the company can survive, it's going to pay you your interest and your principal. So as an analyst, I look at many things for companies, but the size of the company matters. If it's a big company, it's got a greater range of assets usually. Often it's more diversified than the smaller companies, so it has assets it can sell or other means to raise funds to pay interest and principal when they say they're going to. And of course the bonds, because they're lower risk and they are that legal obligation, companies will do all that they can to protect bondholders, and they'll usually do that at the expense of shareholders. So as I mentioned earlier, cutting dividends, for example, is a positive sign to a bond investor because the company is keeping money, it's retaining money within its business to repay you your interest and principal. Whereas if you're an equity or a share investor, that'd be quite a negative sign, and you would expect the equity analysts to be downgrading expectations on the price of those shares. So quite different drivers, and in fact if you're interested in getting into the bond market, it's really important that you get dedicated fixed income research. I'd still recommend that you read the equity research about the company and Google the company and find out as much as you can about them before you invest, but it's because the drivers are different, you're looking at different things, so you wouldn't solely rely on that equity or share analysis. Okay. Please, I haven't got any questions yet, but if you want to ask some, please don't forget about that little table on the side of your, tab on the side of your screen. Okay, a couple of things, a couple of bond facts. The global bond market is much larger than the global share market, and we estimate it's roughly double the size, and in fact other commentators think it's greater even still. The vast majority of bonds in Australia, the biggest issuer of bonds in Australia is actually the Commonwealth government, and they issue about $270 billion worth of bonds. So they're the largest issuer. All the states and the territories also issue bonds, and I think they issue about $240 billion worth of bonds, and the rest are corporations, domestic and international, and other entities. Now, the total size of the Australian market is estimated at $1 trillion. It's a very large global market. And that's bonds issued in Australian dollars, in the Australian dollar denomination. But if you take Australian companies that issue foreign currency bonds, they issue approximately $500 billion or $500 billion in foreign currency bonds. So if you added that into the size of the market, we'd estimate the Australian dollar market, or the Australian market, to be worth $1.5 trillion. So a very, very big market. Now, the vast majority of these bonds are traded as in the over-the-counter market. So the over-the-counter market means that you must find a broker or a dealer to transact on your behalf, and there isn't any listed exchange. So the bonds and the hybrids that you see listed on the ASX are a very small part of the Australian market, less than 5%, and we probably think close to 3% or under still. So quite a small part. So the brokers like FIG, the way that we earn our income is through taking brokerage on the trade. So we match the buyers and sellers. Buyers and sellers come to us and they say, we'd like to sell these bonds. They might be Sydney Airport bonds. We then need to find a buyer for the bonds. So we take a margin between the buy and the sell price, much the same as if you went into a bank and you were looking to buy foreign currency. The bank quotes two prices, a buy and a sell price. FIG and other global dealer brokers working in exactly the same way, where we quote a bid and a sell or buy-sell price, and we take a margin between. So people say to us, well, how much are you taking? It really depends on the size of the transaction. As you can imagine, some of our clients trade in hundreds of millions of dollars and others trade in $10,000 parcels. So the bigger the parcel size, the lower the margin. Also depends on the bond and how easy it is for us to access. So some bonds are quite easy to access, so there's not as much work, but others we're continually trying to access and can't always get stock, if you like, to trade. So it takes longer and there's more work involved. But that's the only way that FIG make any money is through that buy-sell spread. Now, the rates that we would quote you, whether you were buying or selling bonds, they are the rates that you would expect to receive. So the brokerage, FIG's brokerage, is already included in that amount, and then there are no ongoing fees or management fees. And even if you bought a bond now that had 20 years until maturity, and that's all you did, you bought that bond and you sat on it for 20 years, FIG wouldn't earn any other money from you whatsoever. So very much it's a volume trading type business, and so it is always in our interest to find the best deal for you. We work very hard, our dealers work very hard at doing that. Okay, I'm hoping you understand all of that. I don't have any questions, so I'm going to assume I'm doing okay at this point. So a couple of other things that people don't realise about bonds. And first is that you can make higher than expected returns. Now, a good example of this was a few years ago, a company called Stockland, and I'm hoping most of you have heard about Stockland, but they issued a fixed rate bond, and that fixed rate bond, we talk about bonds in terms of being worth $100. So the fixed rate bond was issued at $100, and it had an interest payment of 8.25%. So, and that's a fixed payment that Stockland must pay every year. In fact, every half year it pays $4.12.5 per $100 invested until maturity, when investors then expect to get their $100 back. But you can imagine a few years ago when they issued this and interest rates were high, what's happened since then is interest rates have been cut. And Stockland doesn't have any right to renegotiate that interest rate. The only way the market can give any value to that changing rate and that very high and attractive income is through the bond price. So that Stockland bond, while it was issued at $100, if you wanted to buy it now, it would roughly cost you $120. So you would actually make a higher than expected return of that $20. So quite interesting there that you can make higher than expected gains. You can also lose with bonds, but I think it's important to note that you would really only lose if you sold the bond prior to maturity. And as long as you held the bond to maturity, you would still expect your $100 back. Of course, the other way that you can lose with bonds is if the company who's issued the bond defaults and they don't then pay you your interest or principal. But in Australia, most bonds and most companies are rated investment grade, which means they are very low risk instruments, and the chance of you losing money because of a default is very low. Okay, so how much of your portfolio should you allocate to bonds? Well, each year the OECD does a study of 29 countries, and it studies what their pension fund allocation is. So it looks at all the pension funds in the country. How do those pension funds allocate? What's their portfolio allocation strategy? So in the last study, you won't be surprised to learn that Australian pension funds had the highest allocation to shares amongst the 29 countries, but we also had the highest allocation to cash. And I think that's really because a lot of investors and perhaps portfolio managers in this country don't understand the benefits of bonds. So what's interesting, our allocation to bonds in that study, or those pension funds, was just 9%. Now the average across all 29 of those countries was 53%. So just gives you an indication of how under-allocated we are to bonds. So 53%. Now the reason for that is because bonds have a lot of certainty. They provide a lot of certainty to portfolios. So pension funds that have to provide a known benefit or a defined benefit like to invest in lower risk and higher certainty investments, and bonds fit that category. Whereas now in Australia, most pension funds, it's defined contribution, so it's investors can define their contribution up front, but they also take on all the risk. And of course the way a lot of pension funds market themselves is to talk about returns. So returns for the last 1, 3 and 5 years, and the higher the returns they can show, usually the higher their attraction to investors. So that sort of gives you a little bit of context why we think the allocation in Australia is so low. But when investors come to us with their own self-managed super funds, we like to say to them that you should think about owning your age in bonds, and that's because as you get older, you need to take some risk off the table. You don't have the time to recoup any lost capital that you would have if you were a lot younger. So very important to work out what your goals are in retirement, how much you need to live well, and we certainly think that that's sort of the amount that you should be investing in your lower risk investments. We'd never say don't invest in shares, because shares are a good, of course, growth asset, but you need to work out the difference between those. Okay, so there's 3 types of bonds. The first is a fixed rate bond. Now if you remember, I talked a little bit about the Stockland bond, the fixed rate bond. So you have most bonds issued at $100. You know exactly when your interest payment's going to be paid to you. Fixed rate bonds are usually half yearly, so you can invest each half year, and each half year you'll get an interest payment back. They do have, fixed rate bonds are very, very protective in a declining rate environment, and even at this point in the cycle when rates are very low now, you can often get very attractive rates of return on fixed rate bonds, And of course, my personal thought on interest rates is that they'll be low for longer. So getting quite a good premium on your fixed rate bonds, I think it's worth investing. We don't actually know when interest rates are going to turn, and they still may be cut. There are some economists that still think we're in for a further cut. But fixed rate bonds are most attractive when interest rates are high and when you're expecting interest rates to be cut. Okay, next type of bond is a floating rate bond. So this is just as the name suggests, your interest income will move up and down with the economic cycle. So if rates are expected to move up, you would expect your income to increase to match that expectation in the market. But equally, if you think interest rates are going to be cut, your income then would start declining with that expectation in the market. But floating rate bonds are very attractive when the market is at the low point, because you invest in the floating rate bond and theoretically as interest rates rise, your income rises. Now these bonds are actually what is known as more capital stable, and that means that bond price, that $100 bond price, it stays close to the $100 mark. It doesn't move around as much as the fixed rate bonds. So if you were particularly worried that interest rates were going to move up, you certainly would have a preference for floating rate bonds in your portfolio. Okay, the last type of bond, I think these are particularly attractive at the moment, these inflation-linked bonds. We've just seen inflation over the last 12 months running at 3%. It's now running at a higher rate, or is higher than the cash rate, and is approaching the term deposit rate. I think best sort of TD rates are around about 3.4% at the moment for 1 year. Inflation running at 3%. In essence, you might be earning 0.4%, and if you have to pay tax on that, really your returns are very marginal. Okay, a couple of different types of inflation-linked bonds. The first is known as a capital index bond. These bonds, when they're first issued at $100, that $100 face value of the bond rises with inflation. So if there was a new inflation-linked bond issued 1 year ago at $100, today that value, the face value of the bond, would have risen by that 3% inflation, so it would now be worth $103. And that means that if the company had to repay you tomorrow, it would owe you $103. So over time, these bonds accumulate in value. And I'll give you an example. The Sydney Airport 2020 bond maturing in 2020, I think it was first issued in 2004. The face value of that bond, I think, is now about $135. Might be quite a little bit out there. But if Sydney Airport had to repay you tomorrow, they would owe you $135. But over time, with inflation, these are long-dated investments. They grow, and we think these particular bonds are particularly attractive in accumulation phase. And I know one of my colleagues here in the Brisbane office, he's bought these bonds for his children and plans to use them to help educate his kids when they're a bit older. So you're accumulating value. It's keeping track with inflation. Now the kicker, if you like, with those bonds is that the fixed interest rate that's paid on them, whilst it's low, it's paid on that growing face value. So your income also is paid, is linked to inflation. So if we use that Sydney Airport 2020 bond as an example again, and I think the fixed interest rate is around about 3.1%. So that 3.1% is paid on that $135 face value of that Sydney Airport bond. So in essence, with these bonds at the moment, you're getting inflation plus a 3% margin, which is, I think, far superior to the term deposit rates. And if inflation moves higher, as a lot of global experts anticipate, then you would expect the prices of these bonds to rise, as does their attractiveness, but also does your income. So if inflation goes to 5 or 10%, your capital value of your bond would be rising rapidly, as would your income. Okay, the second type of inflation linked bond is called an index annuity bond, and these are quite different. We really think these are better for investors in retirement. So what happens with these, you pay a lump sum up front, and then the company returns to you principal and interest. So each quarter you get a principal and interest payment, a bit like a sort of a reverse mortgage where the company's paying you, and at maturity the company has totally repaid you the value of your investment. So again, these are very long dated investments. One I like to use as an example is the Melbourne Convention Centre. So they issued a bond. It was a public-private partnership, and they issued a bond to help build the Melbourne Convention Centre, and it's now successfully been built. So it's in the second part of the contract, if you like, where it's cleaning and maintenance. So the cleaning and maintenance phase are an easier and less risky phase, if you like, but all the cash flows that ultimately come to you are being paid by the Victorian State Government. So very, very low risk bond, and I think there's two bonds there. I think there's one out to 2025 and one out to 2033, so very long dated, and you're assured of that quarterly interest and principal payment. Now there's what's known as a base payment, and that base payment is indexed to inflation. So if inflation rises, or as it rises, the income, that quarterly payment to you also rises. So I'm hoping that makes sense. Now I've got a couple of questions here. One from Keith. He said, do I understand that I would have to sell my bonds before maturity to make that extra money? Keith, that's right. With that Stockland bond, you would need to sell before maturity. But at FIG, we have a number of people looking all the time at the value of bonds. Firstly, myself and my colleagues in the research team, we're looking for where investors have made money or where it makes sense to sell and buy something else. Of course, your dealer or relationship manager is also looking at your portfolio for best ways to utilise your investments. And we have another guy here in the Brisbane office with us, a guy called Ryan Poth, and he's a portfolio manager. He's looking from a much broader company perspective on what makes sense to buy and sell. So if you came to us and wanted us to help you set up an account, we would do that. But we do we are in constant contact with our clients, either through our weekly newsletter, The Wire, or by email or by phone, making suggestions. So certainly would help you with that. Okay, I've got a question from Carol. Hello, Carol. She's asked, could we give an example of what it actually means to own your age in bonds? Okay, Carol, so if you are aged 55 now, we'd suggest that you have an allocation of 55% in your portfolio to bonds, or roughly 55%. It very much depends on if you're still working or not, because if you're still working, you still have that income and you have that capacity to recover from a shock. But quite a few of our clients retired at 55, and if you'd retired, you would want to be more careful, I think, or more cautious, or with your investments, and you might want to have a greater proportion of your age in bonds. And I've just got one other question that I'm going to hand over to Jake. Jake, this is a question from Chris, and he's asked, are inflation-linked bonds readily available at the moment?
Thanks, Chris. Thanks for the question. Yes, yeah, and actually they're quite liquid. From my experience in Australia, we do have some trouble sourcing the Investor. There's the capital index bond from Investor, which I like quite a bit, but supply is quite tight on that one. The Sydney Airport 2020 and the 2030, these are very, very attractive capital index bonds, which we see very, very good flows on, not only internally here at FIG, but we see supply coming out of Hong Kong and Singapore, supply and demand, and also internally here in Australia, we've got quite a few counterparties that trade it as well. So I've noticed the last 3 years very, very good flows for the Sydney Airport 2020s and 30s, very, very attractive assets. And quite liquid as well from everything I've seen. So liquid, in fact, that I buy in $5,000 increments for a lot of investors, and very attractive assets. But yeah, so on the capital index side, Sydney airports are quite attractive and readily available. There are some other, there are government inflation-linked bonds that are also readily available, whether it's state or Australian Commonwealth. In the corporate debt side, there is one from Rabobank, only available in larger parcels. Investra, Electronet, there are quite a few out there. From a flows standpoint, supply side, Sydney airports, I see the best flows on that one. On the annuity side, we tend to get some good deals that crop up. I know that the Civic Nexus, which is the Spencer Street Station, another great public-private partnership on top of what Liz was talking about with the Melbourne Convention Centre, not to just keep it Melbourne-centric, but we see some good flows in that annuity. It's a very, very high-quality asset, and I believe the supply is very good on that one right now. The Melbourne Convention Centre, there's a few others that crop up from time to time, and what I do is I alert all investors saying, hey, guess what, we got this offering. If you want to learn more, come to me. Or, you know, if I find it very, very exciting, I start calling out, and I get pretty excited. If I really like a deal, I'll get on the horn. And as far as reviewing portfolios, like I'm reviewing I'm scanning over all my client portfolios. There was a question earlier on that. I'm reviewing all my client portfolios on a weekly basis, looking for value opportunities. On a quarterly basis, I like to break down each and every single portfolio on a much more detailed basis. I like to meet or at least get on the phone with individual investors and discuss their portfolios on as regular basis as they want to. So that's it for me, Liz.
Sorry, Jake, thanks. I'm typing away here. Okay, so let's move on to the next slide. I've got a couple of questions, but I'll hold off on those until we've covered a bit more of the presentation. So I think this is a really important slide. To my mind, this is the most important slide in the presentation. If you can understand this, you can understand, go a long way to understanding the asset class. So what this shows, it's a simplified bank capital structure. Now, all corporations have a structure. This is a bank one. What it tells us is the priority of payments in liquidation. So if a bank was to go into wind-up, you would have liquidators come in, they would start selling down the assets of the bank, and they have to repay those at the top of the structure first. So each rung on this structure must be repaid before the subsequent rungs are repaid their funds. Equally, losses are taken from the bottom up. So each rung from the bottom up must be wiped out before the rungs higher are incur a loss, if you like. So in this structure, and in any structure, if you own the shares, you are in what's known as the highest risk and the first loss position. So you're taking on the highest risk. What the structure really begins to tell us is the sorts of returns that we should expect for the risks we're undertaking. So if you have a high degree of shares in your portfolio, you are taking the highest risk, and you would thus expect the highest returns. Just going to click here. So where do the bonds sit in this structure? Bonds sit in three places. So they sit at the very top in the senior secured debt, so senior secured bonds. In a bank, these are known as covered bonds, and these covered bonds are secured by 8% of the bank's mortgage loan pool. So the bank must set aside 8% of its mortgage loans. If anything happens to it, that mortgage loan pool is used exclusively to repay those investors. It's very interesting, that pool, because just like if you went to borrow for a house, you have to have a certain amount of investment yourself, a certain deposit, if you like. Just the same with those covered bonds. The banks cannot borrow a full 100% of the value of that fund. So it's what's known as over-collateralized. Equally, if any of the mortgages start to default in that pool, they must be replenished so that there's never less than 8% of that mortgage, of the bank's mortgage loan pool in securing those bonds. So these bonds are very, very low risk, and in fact they're AAA rated, so they're rated the same as the Commonwealth government. Very, very low risk. Moving down the structure, term deposits. Term deposits, of course, have the government guarantee, but that's not part of the bank's own capital structure. And moving down again, the next rung, senior debt. This is where the senior bonds sit in the structure. And we often talk about senior bonds at FIG. In terms of bank senior bonds, most of them go for 5 years, and they can be fixed, or they can be floating, or they can be inflation linked. So 3 different types at that level. Of course, you know when you're going to get your interest, and that's half yearly for fixed rate bonds or quarterly for floating rate and inflation linked bonds. And you also know when you're going to be repaid. So you know these exact dates, which really helps you plan your lifestyle, your income. Moving down the ladder to subordinated debt. This is a step lower on the ladder, so it's higher risk. We're taking on more risk as we move down. So the top part of the ladder was secured, then senior debt is unsecured, subordinated debt is still unsecured, but there's some uncertainty in regards to the maturity date. So a few years ago, APRA, the regulator, wanted the banks to borrow for longer, and they did start to borrow for longer. So subordinated debt or subordinated bonds have 10 years until final maturity, whereas the senior debt only has 5 years. But what the banks recognised was that investors didn't really want to lend their money for 10 years, so they have what's known as a first call option after 5 years, and that means the banks can repay after 5 years. Now, all the major banks in Australia have repaid their subordinated bonds after 5 years. So some of the regionals have extended it slightly. Some international banks have also not paid at first call, but the major banks in Australia have always paid at first call. So because you have that uncertainty with maturity date, and you'll appreciate the further it is till maturity of your security, the greater the uncertainty. You're just not sure what will happen to a bank after 10 years, but in 5 years you're pretty certain it's going to survive. I'm going back to that, can this company or bank survive? Because in my mind that's the key question for bond investors. So subordinated debt, possibility of an extension to maturity, you should be being paid more for that. That's an additional risk. You should be being paid more. Moving down again, we move into hybrids. So hybrids are very complex investments, and if you have any in your portfolio, I'd urge you to get a hold of the prospectus and make sure you understand the risks. Even in the last few months, I looked at the last 2 prospectuses from ANZ on their hybrids, and they differ. So just because the same bank might have issued another hybrid, it doesn't mean the terms and conditions are the same. And in fact, what we've witnessed in recent times is that the terms to that first call or redemption of the hybrid or conversion, they've been extended out. So that very last ANZ hybrid issue had what we'd say first call after 8 years. It then had another sort of soft call after 10 years. But if it didn't meet either of those conditions at that time, those hybrids then convert to be, well, they're not convert, but they are then perpetual instruments, which means the bank never has to repay pay you. And equally, because it never has to repay you, you have to sell. So you're taking on more risk there and greater uncertainty, if you like. So you should be being rewarded, appropriately rewarded, with higher income for investing in those hybrids. Now, the other thing about about bank hybrids is that they are all non-cumulative. Not too many investors know about that. That means that the banks can forgo income. They don't have to pay the interest payments on the hybrids, and they never have to make it up at a later date. So you don't have that certainty of income you have with the bonds sitting higher in the structure. So you've got uncertainty of income and uncertainty of when you're going to be repaid. So to actually invest in the hybrids, you should be getting quite a lot higher reward or return for that higher risk. And of course, sitting at the bottom is the shares, where you never have to, the banks never have to pay a dividend, and there is no obligation whatsoever at any point in time to repay you capital. So you should be getting the highest returns from your shares. So a couple of things with this structure I just want to point out. The new bank subordinated debt and hybrids have what's known as a non-viability clause. So under Basel III, the new global bank regulations, non-viability clause, APRA actually don't tell us what that entails. So as an analyst, it's very, very hard to analyse, but in essence, at some certain point, if APRA deem that a bank is no longer viable, so it can no longer operate, it then has the power to step in, and the subordinated bonds and the hybrids in the structure actually convert to shares. So they lose that comfort of that higher rung on the structure, and they take on all the downside risk of the shares. Pretty important to understand that, because you are taking on additional risk, probably at the worst possible time when you wouldn't want to be taking on that risk. So should that conversion happen, I think for me one of the interesting points is that it's not tested, so we don't know exactly how it would work, how they would be converted to shares, and if there is any delay in that conversion to shares, theoretically the shareholders have the option to sell their shares before you as subordinated bond or hybrid holders might. So you could actually be subordinated in the structure in terms of the worst possible time, if you like. What all this leads to is that you really want to make sure that you understand the risks in the investments, and is the return, is it sufficient to compensate for the risk? Now there is just one other point I want to talk about here in terms of the hybrids. The hybrids have an additional clause, and that is if bank capital, so all the banks have to allocate to capital. I talk about it being like a rainy day account. If a bank gets into real strife, it's got to have some liquid funds it can use to get itself out of trouble, and at the moment these hybrids, that pool is 5.125%. Without going into too much, if capital falls below that amount, the hybrids convert to shares. So it's called a capital trigger. And we would expect that capital trigger to happen before the non-viability trigger. So there's different terms and clauses here with these investments. Very important to get your head around what they are and how they might impact you. And again, ask yourself, are you being paid enough for those risks? Okay, one other click here and I'm going to pull up some more tabs. So what's fixed income? Fixed income is the broader asset class, and it does include term deposits and hybrids. So at FIG we are fixed income specialists. So we do have a term deposit brokerage business where we speak to 60 authorised deposit-taking institutions each business day. So all of those institutions qualify for the government guarantee of the first $250,000 invested in the institution per entity. So we do talk to all those institutions and provide our clients with the best term deposit rates each day. So one thing that might be worth considering if you have multiple term deposits, that we could certainly help you find the best rates, all at the brief phone call or being put on our distribution list. The other point to note is that FIG does deal in hybrids, but the hybrids we tend to deal in are from the over-the-counter market and not the ASX listed market. So there are some older style hybrids out there without those conversion and non-viability clauses, and because they don't have those clauses, we think it's more likely they're going to repay at the first opportunity or at first call, if you like. But we can talk to you about those if you would like. Okay, there's a few other questions, but I think I'll just keep going for a little bit and then we'll come back and I'll answer those. So how does the capital structure translate in the market? What we've done here, I'm taking a bit of a look at the worst possible time in the market. So I want to show you what happened during the GFC. So what we've done is we've invested invested $100 in 3 Commonwealth Bank securities. So we've invested $100 in the senior bond, $100 in the Pearls 3, and also $100 in the share. And we've added back interest income or distribution or dividend into that that return line. We haven't added back franking, so it's important to note there's no franking in there. Not everyone can get franking, so we don't include that. So the top line, the dark blue line, is the senior bond. And because senior bonds typically go for 5 years, we make an assumption that one bond matures and we reinvest the interest and the capital in another bond. But you can see that senior bond line is very stable. It doesn't really show too much volatility, and it goes along nicely, if you like. There's not too much volatility, as I mentioned, very predictable, very low risk. Now the second line, the sort of the mid-blue line, is the hybrid, and you can see there's a bit more risk in that. In fact, as at about March 09, you would have, if you were a forced seller in that hybrid, lost about 30% of the value of your capital. You can see then the hybrid recovers, still a bit of volatility. Interesting, if you go right to the right-hand edge of the screen, the hybrid never catches the senior bond. Which isn't what we would expect, because the hybrid is higher risk. We would have expected it to have outperformed the senior bond. Now the third line, the grey line, is the share, and you can see quite a lot more volatility with that share. At the low point, February 09, you would have lost about 55% of the value of your capital, so quite a harsh loss if you're a forced seller at that time. Had you been a buyer at that point, you would have done rather well. Hoping some of you might have been. I have met people that were smart enough to be buyers at that point. But anyway, let's follow the line here. You can see in about April 10, the share nearly catches the senior bond, but doesn't quite. So it moves up, moves down again, but it does catch the senior bond finally in about December 12. So roughly 5 years, if you like, from when the the share price started to decline. It took that long for the market to recover. And since then the shares outperformed, which is what we would have expected. So a couple of things here. I think this graph tells us why it's really important to have a range of risk and return type assets in your portfolio. Had you, during the GFC, held senior bank bonds, you could have sold them without loss of value and then waited for your shares and your hybrids to recover before selling them at a later point. So the low-risk assets, they tend to hold their value much better during distressed markets. So that is why you hold the range. You don't hold all high-growth assets, because if you're a forced seller, you could be expected to take big losses in very distressed markets. Equally, as an analyst, and I've been an analyst for many years, at least 20, to my mind, if I look at the ASX 200 and I look at what do I think is the lowest risk company in that market, here it is, the Commonwealth Bank. So here's, to my mind, what is the lowest risk company, and here's the sorts of volatility it experienced. So you can imagine some of the higher risk type single mining or services or biotech companies, the sorts of volatility that they would have displayed in their investments. So again, I think it's just worth looking at the worst possible time. This is what happened, and I think this is very much why you should own a range of securities in your portfolio. If we move to the next slide, this is a slide, it's UBS's Composite Bond Index. So UBS is a big Swiss bank. They have for many years tracked the performance of Australian dollar bonds through their Composite Bond Index, and about 70% of that index is government bonds. So we're comparing that index with the S&P ASX 200 Accumulation Index. Again, with both of those indices, we're adding back interest or dividend payments. This is a much longer graph. So in September 1989, UBS invests $1,000 in each of those indices. And over 25 years, we look at the performance of the two. So the UBS Composite Bond Index is the grey line, and you can see again that's a fairly consistent upward sloping line. Not too many surprises there. Whereas the S&P, the ASX 200 accumulation index, it underperforms the bonds for quite a long time, and that's during a period of high inflation, and government bonds were issued at high rates of return. But then you see from about September 02, the S&P index start to climb. It hits that lovely peak in 07. Again, I'm hoping some of you were fortunate enough to be sellers then. It then takes a big dip. It rises again. Just showing you the volatility here. Finally, and this graph actually goes out to about April 14, the shares overtake the bonds. So what's interesting here is that over that 24 years, the S&P index has returned 9.16%, so very close to that 10% that we're told to expect with shares. And if you add back franking of about 1.3%, you get about 10.5%, so spot on where we would expect. But if we look at the UBS Composite Bond Index, it's returned 8.72% over that time, so less than 0.5% difference, particularly when you're looking at high allocation to government bonds, so much lower risk investments, really not returning that much less than the share market. I think that's a bit surprising to my mind. Okay, let's move on. I've got some questions for you now. So I'm going to ask you, what's your risk appetite? I think this slide's hilarious, so I'm hoping you're with me and you're having a look. I think it's really funny. I look at this woman here trying to have a bite of that hamburger. Look at all that cheese and those calories. She's really excited by it. No way would I eat that. I don't know about you guys. Not on my list of, not on my diet list anyway. So what is your risk appetite? Instead of thinking about returns, how much risk do you want in your portfolio, or can you afford for that matter? Higher risk definitely means an increased chance of loss and an increased chance of volatility. We've shown that through those slides, Commonwealth Bank. And it's fine, risk is fine, but as you age you really do need to think about taking some risk off the table and protecting what you have. Now, a loss of capital can wipe out your future earnings. So you take on a loss, you still in retirement or near retirement have to live, so you still have to draw down from your investments. It can mean a lower lifestyle, or a lifestyle that you hadn't planned or doesn't meet your expectations. Again, I really like this slide. I don't know how they've managed to capture the guy falling off the surfboard at the particular point that it breaks. I don't know, there's some clever digital guys out there. That really concludes my part of the presentation, and I'm going to hand over to Jake now to finish up. We do have some questions, but I think we'll continue on with the presentation until the end. So I'll hand over now to Jake.
Thanks, Liz. Yeah, risk is difficult to quantify, and especially 5-6 years after the GFC, complacency certainly set in, and the fear that I had during those times certainly complacency set in. But I do recall quite clearly some pretty hairy periods where I questioned whether capitalism was a viable method of transferring assets around. But we're talking about the safety side. That's the whole point of the term deposit and the fixed income bond area. It's to allocate towards the safety side. And just recalling dealing with a couple clients last week that came in, Rosie and Tony, wonderful couple, recommended to me, and yeah, I just wanted to talk to them about what bonds were. And I put together a sample portfolio, and this is pretty typical. It kicks out about a 6.02% return overall. A good mix of fixed, floating, and inflation-linked bonds. Running yield at 5.58%. A running yield, we didn't really touch on this, but running yield is a kind of like a dividend yield, but for a bond, essentially. So it's a percentage cash flow. And the total return per annum for the overall portfolio was 6.02%. That's pretty normal for a good, solid, diversified, quality bond portfolio. It's anywhere pardon me, anywhere from 5.5 to 6.5 is pretty normal. Some of the bonds that were in Rosie and Tony's portfolio are these top picks that I'm going to be highlighting for you right now. First one is a polarizing name in this country. Certainly in my career, I haven't been a big fan of the equity side of airlines or anything to do with wood, really. But on the credit side, on the bond side, this is actually quite a good company, given the return that you're making off it. This is Qantas, of course. This is the senior bond of Qantas. Company that's been around since the 1920s. It's their largest airline with at least 60%, 62 or 3% of the overall marketplace here in Australia. It's got quite a bit of cash on hand, anywhere from I believe it's about 2.4 billion of cash, undrawn lines of credit with the banks currently at 630 million. They've got about 14.4 billion of what's called property, plant, and equipment. I know that the share boys, the equity side analysts, number of months back were targeting about 2 to 3 billion value for their frequent flyers points. These are all triggers that I rely on, being on the debt side, being a lender to Qantas. These are things that are there to protect me. So this is the senior bond from Qantas. This is a fixed rate bond offered at a 6.57% return, available to be bought and sold in $10,000 increments. So a good high quality fixed rate bond. Given the return that we're making, we feel that we're being compensated quite nicely for the risk, and given the credit metrics of the company. And that's where folks like Liz and her great team of analysts help us to make sure that the assets that we're acquiring, we've got good assessments of the risk, and are we being compensated correctly or enough, or overcompensated, like I believe we are in this Qantas. I guess the next bond that is the inflation-linked area. This is another one of my favorites. This is the Sydney Airport 2030. Sydney Airport, this is a senior secured bond, so quite high up the capital structure. Of course, Sydney Airport is the largest airport in Australia. You don't fly into Australia, you fly into Sydney if you're coming from overseas. This is again the senior secured bond, available in $10,000 parcels. It's a monopoly major infrastructure asset and quite an attractive overall return. That's 6.24% return. That assumes a 2.5% inflation rate. We're here at FIG, we're conservative with our numbers. Even though inflation has been tracking at 3% for the last 6 months, and at 2.6 and 2.7 for the quarters prior to that, we still assume a 2.5% inflation because we feel that's the appropriate number. That's the middle of the range. So assuming a 2.5%, which is understated currently, this bond, this senior secured bond, offers you a 6.24% return, so quite an attractive asset. We didn't include any floating rate bonds there. Some of the ones that I'm still somewhat interested in, there's a National Wealth Management floating rate bond that I'm still interested in acquiring. There's a Suncorp shorter dated 2015 bond that I'm still attracted to. It's again a floating rate. But apart from that, there's not a lot of them out there that I'm very, very attracted to, but I can still find some very, very good value. But this Qantas and the Sydney Airport, very, very good risk-reward trade-offs right now. Other bonds that we have on offer are foreign exchange bonds that can offer some different forms of diversification in the U.S. dollar space, and we offer bonds in U.S. dollars, yen, British pound, euro, and some of the bonds, especially the ones issued from here in Australia in foreign currencies, can offer you some very, very good returns if you happen to have pounds that are earning close to zero, or U.S. dollars. I'm a buyer of the U.S. dollar Newcrest bond, available in $10,000 increments. So, yeah.
Thanks, Jake. It's interesting that you talk about the foreign currency bonds, because Reese had a question for us, and he said he assumes foreign currency bonds carry exchange rate risk, which they do. That is right, Reese, including gains if the Australian dollar drops. That's certainly true. We have a number of investors at FIG who have bought particularly US dollar bonds with that expectation. That's what they're saying to us. It's their call. So there are options, lots of options for investing in foreign currency bonds through FIG. As Jake said, in many different currencies. The Newcrest one is one of our favoured ones at the moment, and I think my recollection is, and this is last week, it was paying about 4.2% yield to maturity. Is that right, Jake?
I think it's a little bit higher than that. I
Okay.
know that I've been buying it anywhere from the last 6 months at 5% down to, I think it's about 4.6, 4.5 currently. It could be a little bit lower. Actually, it is quite topical. I think they had their earnings today, which our credit analyst, I haven't had a full read myself, but I think from a credit perspective, it's quite positive. They're trying to reduce their costs, which of course makes them a better lender.
Okay, thanks, Jake. Just another question while we're on it on this page from Viv. Viv wants to know why invest in bonds through FIG versus, say, a Vanguard fixed interest bond exchange traded fund, and also does FIG offer the opportunity to invest in hybrids? Great question, Viv. One of the reasons you would invest in bonds through FIG is because you get you have control over what you invest in. So you know absolutely what you're investing in. You know when those interest payment dates will be, and you also have that natural maturity of the bonds. If you invest in an exchange traded fund or a managed fund, it's then up to the manager of the fund to declare a payment to you. And that they can vary, so you don't actually know necessarily what your income will be. In terms of the exchange traded funds here in Australia, most of them are invested solely in government bonds. There are a couple that I've looked at with an investment in corporate bonds, but they're typically not very diversified and again very low risk. So the managed funds in themselves, they have to have a certain allocation to government bonds because they need to be able to meet redemption requests when they occur. So they have a certain proportion in very low risk, low paying investments. But equally, and this is particularly the managed funds, not the exchange traded funds, you don't actually know what you're investing in. The managed funds will tell you what the top 10 investments are or the top 20 investments, and whilst they are often have greater diversification than investing direct, there are some very strange assets and high risk assets in those funds to make up those attractive returns and to compensate for the low paying government bonds. So I've seen things like Turkish mortgage funds and all sorts of things that I think a lot of investors, if they knew 100% what was in those funds, wouldn't be happy investing in. So I guess really in terms of investing direct through FIG, you have control. You know when your income is going to be paid to you. You know when your principal will be returned to you. In terms of the managed funds, again, you are paying a manager to oversee the fund, so you will pay ongoing management and performance fees, and there is the opportunity that that fund could be frozen. So we have seen in the past managed funds frozen because, as you can imagine, if all of the owners in the units want to redeem at the same time, doesn't mean that the manager of the fund can necessarily unwind or sell those bonds all at the same time. So we have seen funds frozen. That hasn't been the case and is not the case with direct investment. So I'm hoping that's answered your question. I think that's all the questions we have for the moment. So if you have any questions, please send them in as we are getting towards the end of the presentation. And I'm just going to move to the next slide and hand back to Jake. Thanks, Jake.
Thanks, Liz. Viv, just to follow up with that the managed fund or ETF for that matter, I guess the way that we charge is bid-offer spread, as we kind of touched on before earlier in the presentation. With managed funds, they also go through those bid-offer spreads as well. I mean, we deal with many of the funds out there, and so managed funds also go through that bid-offer spread, but they also add on top their annual fee. You can imagine if you buy a bond up front, and you pay the one fee by buying it through us, and it's always whatever quotes we show you, it's already incorporated there. That's it. There's no other fees that get applied. It's not every year you get charged. It's the one time up front. So in my experience, it tends to be a much cheaper way to actually invest is to go direct. But ultimately, it's always your call overall. So Let's just keep driving on here. The next steps. Look, The Wire is a great, great publication. We cover all kinds of things. Liz does a great job with this publication. It covers new issues, the term deposit rates, inflation expectations, our thoughts on where interest rates could go, offers we're seeing out there, the credit metrics of, I guess, Newcrest will be covered in this week's, I'd imagine, and all kinds of different things. You probably get a lot of stuff on your inbox about property, definitely, and shares, definitely, but not many outfits out in the marketplace covers the interest rate world. And that's all that we cover. We don't wear every hat under the sun. We're just here to be the experts on the fixed income side. And that Wire publication, I highly encourage you to sign up and read that on a regular basis. It's free and available to you, and a great, very, very knowledge-driven publication for you. I also encourage you to open up an account. There's no cost. There's no downside. There's no obligation on your front. Getting the account open means that you can sign up online, see the daily pricing updated online. It's all open and available for you. Getting the account will take you 5 minutes to fill out the paperwork online. Gets you ready and able to act. You can't act unless you actually have the account open. But just because you have the account open doesn't mean that you have to do anything. So I encourage you highly to get the ball rolling online. You can get the account opening pack, or certainly call us. We can certainly walk you through it. But simply having it open and available opens up this giant marketplace for you. And we're here to walk you through the details of it and to make it as easy as possible, help on the education side, which is what this webinar is all about, and to hold your hand to the point where you're comfortable, and then you can start doing it on your own, or certainly rely on us as well. So I encourage you to get the account open. I encourage you to set up a meeting with folks like myself. I'm in the Brisbane branch. We've got a few others here on the desk with me, but we've got offices in Perth, Melbourne, Sydney, and of course me in Brisbane. So set up a time, meet with us, or give us a buzz, ring us to find out, is this asset right for you? Kick the tires very hard. This is your life savings, or at least a part of your life savings. You've got to make sure you're comfortable with the asset class, and that's what we're here for. We're here to help you on the education side and walk you through what's going on in the fixed income marketplace. And again, that's all we do. And I guess what I'd like to leave you with is that just consider the fixed income part as part of your investment strategy, where it's part of your defensive camp. And the whole point of this presentation is to make your cash work harder. So if you're going to do so, consider using us. We're the fixed income experts, and thanks so much, and let's make your cash work harder for you.
Thanks so much, Jake. Well, we're getting towards the end of the presentation now, and if you haven't asked a question and you would like to, there is still time. I'm just going to summarise now and just mention again that bonds really have a place in every person's portfolio, no matter how old you are or what your circumstance. Bonds sit very neatly between cash or deposits and shares in terms of risk and return. They are slightly higher risk than term deposits and do pay slightly higher returns. But those returns, interestingly, can compound very quickly, because bonds pay interest either quarterly or half yearly, whereas with a term deposit, if you have a one-year term deposit, you get just a one-off annual income. So there is the chance for higher income that compounds quickly without the risk and the volatility of the shares. So again, investing across and broadly across all asset classes for diversification and for smoothing returns is highly recommended. I just want to say finally thanks, Jake, for joining me today, and thank you to all of you that are dialed in and have listened to the webinar. We have a lot of resources available on our website. There's little videos, there's certainly a lot of articles and education articles and research, of course, on any of the companies that we've mentioned. In terms of bonds, there's many thousands of bonds out there, and if you don't like any one particular bond, we certainly would work to find others that might suit. We are very much a bespoke, tailored service, so we like to get to know our clients, and certainly in contact with them on a frequent basis. And if we can help in any way, we certainly we certainly would. So once again, thank you very much for joining us. It's been a pleasure to have you dial in. There will be a recording of the webinar put up on our website if you want to listen again or you missed part of it. You would also then see the other slides. I know a couple of people had